So, hello and good afternoon. I welcome you to today's special webinar exclusively here for JFD Brokers, how to trade the market opening of the US markets. My name is Jens Klatt, and I'm the Global Head of Research and Education for JFD Brokers. And yeah, I want to guide you here through the next, in fact, 45 minutes. And in the next, in the next 45 minutes, we want to have a look at the current performance of the European equity markets. And not only that, but also how to formulate a trading setup then. All in all, I think we will start, that makes the most sense, I think, with the European market opening first. And have a look here. And what I can say, by the way, here's already the open range of breakout setup, which we want to make a topic a little later then. What we can clearly spot, that's, by the way, the S&P. You're just wondering? No. First of all, let's have a look here at the DAX and then switch over to the to the S&P again. You've seen several lines there, vertical and horizontal lines, and I want to show you what I highlight with these. But first of all, let's have a look here at the current price action in the DAX, which is here trading lower currently. And in fact, it's no big surprise. It has something to do with the fact that we have a special day tomorrow here, and no, it's not a special day. That's too much. But it's a small expiration here at the Eurex. This is where the future DAX is traded, and at the Eurex, the small expiration has shown, and that was also a topic last week, that there is some serious demand potentially coming into the market once we push above 12,500 points. That has been a topic already last week here on Thursday. And then probably some of you might recall that last week we had some trouble taking on momentum after a solid start into the trading week, in fact, but the market drifted lower then. That was mainly due to the fact that there was some fears building around the trade war between China and the US, but also on top of that, a potential, or in general, the geopolitical tensions here between the US and Russia in Syria and around the situation in Syria. And once Donald Trump last week tweeted that he never mentioned that there will be a near-term escalation in terms of an attack of the US here, of Syria, respectively the Assad regime here, the DAX took off and pushed higher and already started to squeeze above 12,400 points, set back, and then took off again on Tuesday. That was, in fact, also something which could have been expected to some extent, I think, because after the attacks which then took place over the last weekend, what happened was that the DAX presented itself quite stable and then took off here. And when looking at the 5-minute chart, what you can clearly spot is the following here. It's a really dynamic move on the upside, which took already place here from shortly after the spot opened. So we opened stronger, set back, closed this untrue gap, traded back towards the 50 exponential moving average on a 5-minute time frame, which is in fact acting for me as a trend filter, but also which can be seen as a very interesting and dynamically moving support and resistance line. So it's no coincidence here that we traded back to this level several times and found support there, and the market traded higher, while it wasn't so big, such a big surprise after we fell below that level here, that was yesterday, that we then drifted lower. And as you can see here, or several times also before, that happens over and over again, that this 15 exponential moving average on a 5-minute time frame, in the DAX in this case, is respected as a support and resistance line. But let's come back to this move here on Tuesday. So it was a really dynamically move, and it made the impression that there was some hedging going on. So what you could see in the open interest here at the Eurex was that, let me just think about this. 1 1 second. I just want to show you a chart here. I think that makes the most sense. The problem is that it's a German research piece. I presented on the website here from JFD Research, or on JFD Research, which you can find here, jfdbrokers.com, and then JFD Research. And now let's have a look here at the weekly piece I wrote together last week. And there you can already see, I was talking about a potential short squeeze here with target around 12,800 points. And that's what I was referring to here. That was from last week, Friday. And then what you can see is that you have here the strike price, and here you have the open interest. So in fact, the left and the right column is what is of interest for us. And we were trading below 12,400 points here. Oh no, not true. I think we were slightly trading above 12,400 already. That's something I mentioned already a few seconds ago. That was here. Yeah, 1 week ago. And then we traded up to 12,500 points. But what you can clearly spot here is that there was an open interest which was quite elevated at 7,600 points, but also 12,600 points here. And then the next higher open interest, sure, it's the next round number, 12,700, but this is a 5-figure here. It's 10,000 contracts open interest here. And so now some of you might wonder, why is that of interest? Well, it's I want to make it as easy as possible. But it's definitely worth to give it a more detailed look here. So what are we looking at here are so-called short calls. So short calls have the following payout structure. As you can see here, you're making money up to a certain amount. This is kind of the premium you're getting for holding, in this case, it's a naked short call. And this is the premium we get. And once the market pushes above a certain threshold, which in this case, let's say is 12,500 points, then you obviously start to lose money. And from 12,550 points, you start to get really, you get burned, okay? You're losing money. And now what you have to do is you have to hedge this exposure somehow. Make it as easy as possible. What does it mean? Well, it means that you have to buy something which has the following payout structure to equalize this drop here on the lower end, and try to equalize it with the payout structure which is of that which has such a payout structure here. And what does this mean? Or where do you get this? This is something you get by buying the FDAX future, in this case, or the future contract of the underlying product you're looking at here. And so this is then where the thoughts around hedging comes into play. Because if the market hits a certain threshold or makes it above a certain level, for example, here, making it above the highs from last week on Friday, the market really took off, and you can see that there was no real significant pullback, but instead the market shot dynamically higher. And that was mainly due to the fact that market participants who held a position of such a payout structure and who started to lose money once the market pushed above 12,500, 550 points, who had to buy the DAX. And if this demand does not find market conditions which are of equal supply, well, what you usually get to see is a dynamic move, a short squeeze here on the upside. And this is exactly what happened here. Now, why do I mention that? Since this is the price action from Friday, and I mentioned this already during the morning meetings, which are taking place every morning at 9:30 a.m. GMT on the YouTube channel here from JFD Brokers. So why is that of interest? Well, I have made the following observation over the years. Usually such moves happen from time to time, and this is an exploration. It's worth to give it a look here every time. And the interesting thing is, after the market hedged this exposure, it stabilized usually at a high level and then sees a pullback. So giving back most of these gains here. And this is something which is getting or playing a role right here. And it's one of the reasons why I was very skeptical if there's so much more potential on the upside today for the DAX. And I think it's no big surprise to currently see some pressure in the European markets, because this is a behavior which you can see over and over and over again. So by the way, if you want to find data around this here, you can Google it by only typing in DAX options and Eurex. So this is what you have to Google. And if you do that, well, then you find Eurex exchange here, DAX options, and this is where you click on. This is where you get this data. 1 second. So there you scroll a little. You can already see here calls and puts. It's not this, but you can find statistics here at the end. And there you can look at the calls, respectively puts, which are expiring here on the 3rd Friday each month. And now let's have a look here at the developments in the DAX. So currently there's obviously some pressure forming. The only question now remains, is this really sustainable pressure? Because what I have to say is that based on my personal experience, usually you get to see bigger pressure, higher pressure, which builds up here. And this is not what's really happening. So to me, based on the current price action, based on the fact that we are trading below these two blue lines here, the turquoise one is showing the first tick in the morning in the DAX here in this case at 7 a.m. GMT. That's the moment when Xetra opens. And the blue line, the deep blue line, is the closing price from yesterday. So, and we're trading below this, which means also, on top of that, we are trading below the third blue line. This is the 50 exponential moving average on a 5-minute time frame. So if we combine all this, we are obviously currently seeing some bearish touch in the market. It's still neutral, I have to say, since there hasn't been a dynamic break of the lows from yesterday. But the neutral picture we get to see here has definitely some kind of intraday bearishness attached to it. So nevertheless, I think that we shouldn't, based on that, now conclude that the overall advantage can be found on the short side, but instead, probably we should be a little careful for US equity markets, because the thing is, this is the next thing. When looking at the Dow Jones, for example, and now we are switching over to the US equity markets, well, what you can clearly see is that the market drifted higher after testing the 200 simple moving average here. Didn't make it below that level at the beginning of April. That was, by the way, the Easter weekend. And is now drifting higher. And you probably might assume that this move here looks weak, and we are probably about to see the next leg lower. The only problem I see with this is that currently what we definitely need to see for this is an external trigger which hits the markets and surprises the markets. And this is something which I somehow can't see happening right now. I mean, there's all the time fears around Syria and an escalation, especially between the US and Russia, for example, or there are tensions here from a trading perspective, let's say, so trade war fears, which could all the time escalate. But all in all, it seems as if the situation presents itself quite stable. And what I want to show you, where you can clearly see this, is when looking at Bloomberg here. There you have the chance to search for the VIX. This is the volatility index on the S&P in this case. And what you can see here is that the VIX is drifting lower, coming significantly back from above 20 at the beginning of the month here. That was there. So that was the last time around Easter when we traded significantly above 20. And now, as you can see here, volatility is dropping. And this is showing that the market is obviously willing to sell volatility and is not really seeing a short-term escalation. I mean, the market can be caught on the wrong foot here, sure. And we could definitely see a squeeze higher once such a geopolitical escalation around Syria or trade war fears are brought up again. Nevertheless, we have currently a tendency which is clearly indicating that we are potentially about to see the Dow Jones here, in this case, respectively, US equity markets, to drift higher than to drift lower. And so based on that, for example, I'd be really careful to now say, well, based on the current weakness or this drift lower in US equities so far over the course of today, well, I'd say, well, probably it's better to to wait and see a little, let's say, and probably don't go into the, let's call it, discretionary mode here, and saying if there is a long setup triggered in the S&P after or based on the based on the opening here, and I'll guide you through the setup we will look for here in a few seconds. Well, then I definitely, nevertheless, go for a standard position size. Because the overall picture is not that clear, not that clearly bearish in this case, and it really can't, or it does not show any bias so far, even though European markets seem to be lower. But I think it's more sentiment driven than it's really kind of risk aversion forming or something like that. And that's something which will lead me to the conclusion, which leads me to the conclusion to say, well, I just go with the standard setup here in this case. For example, when saying I risk 1% per trade, I'm not reducing the position size to say 0.5% when trading the long side, while going for 1%, probably slightly more than that when trading the short side. But instead, look at it from go for it from an equally weighted perspective, meaning I'd go for 1% risk each, or probably reduce the position size, since there is no clear tendency to be seen here, meaning probably I'd reduce the position size for both sides, going down to 0.7% while trading the long side, but also go for 0.7% when trading the short side. So yeah, that's the overall picture I draw currently here. So now I want to get you here through these lines, and what do they mean? So in fact, very, very easy. The red line is the high of the day before, which can be found here. By the way, spot high. I'm talking about the spot high, which can be found here, by the way, between 1:30 to 8 p.m. 1:30 till 8 p.m. GMT. We have to adapt this accordingly. So here, that's it for today. 3:30. So the green line is the low from yesterday, which is here. And the blue line can be found here, which is the closing price yesterday at 8 p.m. GMT. So the turquoise line can't be set right now, because therefore we have to wait till we see the first tick at 12 minutes at 1:30 p.m. GMT. This is the spot open here. It's also something you can see here. You can see there that this was the first tick yesterday. And to me, it's important information, because I see right when looking at the picture here, are we trading above that or below that? The problem with the S&P, and why do I do that? The question arises surely. Why do I do that? Well, the thing is that the S&P is traded nearly around the clock, so there's only a slight a small break here between 10:15 till 10:30 p.m. GMT, German time, so 8:15 to 8:30 p.m. GMT here in this case. So I only want to make sure that I don't need to look for what's the current price action here, where's the main volume traded, and I just want to have it right at first glance here. So, and usually you can say this is when Wall Street opens, even though it's traded around the clock here, the S&P future at the E-mini S&P at the Globex, the main volume is traded within this within these two vertical lines here, when the spot, or respectively the Wall Street comes to life then here in this case. So this is usually when volume picks significantly up, and when moves become more sustainable is the wrong word for this, but moves have depth, let's say. It's a broad and deeper market than what you get to see here overnight trading, for example. So now let's have a look here at this setup I wanted to present to you. So it's only 3 steps we are going through here. So the first step is we define the open range between 1:30 to 2:15 p.m. GMT. This is where we look at the high and the low of this range. Then we'll look at the advantage, meaning we're using the 15-minute exponential moving average on a 10 here, exponential moving average 10, which means if we trade above that, we are only taking long engagements. If we trade below that, we are only taking short engagements. So it could be, for example, and therefore, let's have an example here at the DAX probably, because here I'm using the 50, and that sometimes gives a better impression. So when looking at Tuesday, for example, I have another open range here, but I think it perfectly illustrates my thoughts here. So when saying I have the open range here between these 2 lines, so it's the high and it's the low, we're looking at 6 a.m. GMT till 7:05 a.m. GMT here, the high and the low. And now look at the following. So obviously we are breaking out of this range within this candle here. This is 7:05 a.m. GMT. We're breaking on the downside. If we're not taking this signal, well, we're definitely taking the signal of the red candle here at 7:10 a.m. GMT. So the thing is, do we trade the short side to break out of this open range on the downside? No, we don't. Why? Because we're trading above this blue line, the exponential moving average 50 here on a 5-minute time frame. So when we're trading above that, we are only trading long engagements. We are only taking the long trades. We are not trading short trades. So in this case here, in fact, we haven't traded at all. So probably I might assume, okay, well, if you traded the long side for this break, obviously there was a nice trend which developed, but it's not based on this setup because the breakout of this open range here occurred on the downside, and we're not taking this short trade, while we are also not taking any long trades here because the trade out of this range here took place on the downside first, and so there's no trade that day based on this setup. And this is the same what we want to do here for the S&P in this case, and why I clearly define it and say, well, we are only trading the short side when trading below this yellow line in this case, and we're trading the long side once trading above that. And then the question arises, okay, and where do we place the stop? Well, after the breakout of the range in direction of the advantage identified in 2 here happened, we place the stop above, respectively below the high low of the range, and then just go with the flow. In this case, meaning we're going in direction of this breakout. And now the next question is, okay, and when do we take the trade out? So is there a take profit level? There's in fact a time take profit, which means we're taking out the trade at 7:50 p.m. GMT. Whatever, if it's not stopped out in this time span here. And in fact, some backtests showed, or no, not some backtests, but backtests showed that such an approach is even more profitable than looking for preset targets on the up, respectively on the downside. Once a break in direction of the identified advantage occurred here. By the way, I'll show to you here the result of the backtest a little later on. But this is what we do. We just have the stop identified based on the range, and then we just take the trade out automatically at 7:50, in this case PM GMT. So 10 minutes before the spot market closes, and just hope that the market moved in our direction, or probably didn't. Hopefully we didn't get stopped out. That means nothing more than we're taking only a smaller loss than we would have taken in case of the market here, stopping us out and going out of the range on the other side. So let me just give you an example of how this worked here yesterday. By the way, I just have to see. Oh, this is this is a really interesting development. So what I know is that yesterday I had 2 orders in the account statement, which I was sent here in the evening then. And it was in fact a short order, which wasn't triggered, which is, by the way, coinciding here. So the low of the range is coinciding here with this green line, which is the low from yesterday. And what you can see is that here, this low obviously wasn't triggered. So this is it's a close one, but it wasn't triggered here. And where's the high? Well, the high is in this candle, I think. It's 713.5. 713.5. Where is it? Here. So this is the high. So now something interesting is happening. So this is the high and the low, and obviously there is no break out of the range on the downside, which, by the way, would have triggered our short trade here, since we were trading below this yellow line, the exponential moving average 10 here. So we're clearly trading below that level, but the market does not trigger that level, but instead reverses. Now something interesting happens. The whole setup reverses, because we are now trading back above the exponential moving average here. And the next candle here results in our trade being triggered on the long side. So as you can see here, the market is attacking the highs, but hasn't closed above the exponential moving average 10 here on a 50-minute time frame. So, but we have to wait. And the next candle, once it opens, shows that now we are going long with the breakout of this range on the upside. Unfortunately, the trade didn't take off, not on the upside, but also the market did not collapse. But in fact, the market here is currently, or traded out, and probably, yeah, we saw a small loss of something like, I don't know, 3 points or so. And we're stopped out here. Yeah, and so in fact, that's the setup for yesterday. Probably a little more interesting, because this is really, it looks a little, is it right to call it pathologic? Not sure. 1 second, I just want to have a look here. I had a professor in university who was, once things got complicated or not really clear, not really nice, was talking about I think it's pathological. I think it's pathological, yeah. Yeah. So it's not a really nice market environment. So therefore, let me just show you a clearer example of the day before. Does it work? Here. So I think this is the low from the day before. Yes. And this is the high. Yes. So now you can clearly see why I use those vertical lines here, because you have to really see if this is the right time. And I don't have this problem here when I see the vertical line, which is the start of the trading day, spot market trading. And then I just look at the high and the low. In this case, yeah, obviously it's a little more difficult here. But what you can also see is the market has built this range here. Here's the low. This is the high. And then we're trading above this yellow line, and we're breaking out of this range. And the market takes off, and we see a profit of, I think, somewhere here. The market took us out. So the trade was taken out. That was at, again, 7:50 p.m. GMT. And with the break here out of this range, we saw a profit, small profit, not big, I think. It's what we have here, 2,701. Trade is taken out at 709, 710, somewhere here. So that's the profit, in fact. So when taking the trade here, when going long here, the initial stop can be found below the range, which is here. So this is where we place our initial stop, and then we just go with the breakout in direction of the identified advantage. And this is exactly what we want to wait for today too. So now the market opened. It's 1:30 p.m. GMT. We'll just bring this turquoise line to the open of this candle, which is at currently 700, nearly 700 here. In fact, this is a small gap which we get to see here. So it does not affect our overall trading. Therefore, we have to wait for the first 45 minutes of trading now to happen. But the interesting thing is that nevertheless, there is a tendency that the market tends to close these gaps, or they tend to close the gaps if they are not exceeding a certain amount here in terms of points. And in this case, it's 3 points, which is most likely to be closed here in this case. So probably we're not only closing the gap, but also trading back towards this closing price from yesterday here at 8 p.m. GMT. Something we have to definitely wait for. Nevertheless, our setup will be formulated in 45 minutes from now, so at 2:15 p.m. GMT. And yeah, what do we have to wait for? Obviously, high and low of this range. Then are we trading above or below the exponential moving average, and then trade in direction of the identified advantage. That's it. With a stop above, respectively below, depending on which direction we trade, of the high of the range, low of the range. And then we're going for a trade in direction of the identified advantage, and we'll close it at 7:50 p.m. GMT. So at the end of the spot, 10 minutes before the end of the trading day here on Wall Street. So now your question is very simple. You might wonder, okay, and this is really profitable? Yes, it is. It is very profitable, in fact. It's easily duplicable and highly profitable strategy. 1 second, I'll just show you. One second, where I have it here. So that's a chart from a backtest, which was run, here from November 2010 till I think July 2017. That was, or is a screenshot I took from Stefan. Stefan is a PhD in physics, and he tested this approach via his capabilities, via his data sets and everything, and optimized it, in fact, a little. Knowing that I was trading this approach, and we wanted to present it to the audience here back in July during an FX Street webinar. And so the interesting thing about this is that you can clearly spot that it's a clear uptrend in this equity curve, and it's showing us a profit, significant profit here, and a hit rate of 47%, a payoff ratio of 1.3 to 1 when dividing the average profit through the average loss, and all in all, a profitable approach. So some of you might probably wonder, is this really profitable? And this backtest shows it is, at least for the last 7 years, and even longer back into the past than the last 7 years. And in fact, that's it around this approach. So nothing more to add. The great thing about it is that we have a clear preset. We have clear rules we can follow, which means nothing more than there's no need to hurry up now or to be excited or something. But all we do is wait for the first 45 minutes to take place, and looking where's the high, looking where's the low of the range, and that's it. So, and then going from there, trading the break in direction of the identified advantage, having a stop, having place the stop below, respectively above the high of the range, below the low, above the high, and then just go from there. So now you can see here that the S&P is obviously losing some ground. I think it hasn't closed the gap so far, right? No, it was 702. So the gap would be closed at 703.5. So let's just see. I mean, probably we will continue to trade lower here, which, by the way, makes it then quite likely. Wait 1 second. Makes it quite likely that also the DAX will head towards 12,500 points. Ooh, this is surprising. Look at this. I mean, the DAX is quite stable. That's interesting. I wouldn't call it a sign of strength here, but probably has something to do with the euro, which is coming lower a little. No. That's interesting. That's an interesting decoupling of those two markets. Usually you have a high positive correlation, meaning S&P going lower, that should usually drive DAX lower, and the other way around. Probably the DAX has some outperformance potential then, if the S&P shows that the move lower right now is not sustainable. meaning if the S&P is coming back and really closing the gap, probably not just closing the gap, but also trading back towards the closing price from yesterday, that could also drive the DAX significantly higher. So this is definitely something getting interesting here. Okay. Interesting question. Someone asking why I do not use a Bloomberg terminal. It does not offer any value to my trading, respectively my research or something. In fact, it's true. So I worked with Bloomberg when I was trading with a stockbroker. So I was a trading assistant. That was at my early 20s. I was working for a stockbroker here in Germany, and this is where I also learned how to trade the markets, what's important and all this. And they were using Bloomberg terminals, but not because of the great input it had in terms of to formulate profitable trading ideas, but it was more like we were pricing also sometimes very illiquid penny stocks. Sometimes it were penny stocks, and that was sometimes very, very difficult to spot the real reasons for certain moves. So if someone comes and is saying, hey, I want to buy 10,000 whatever penny stock, you're wondering, okay, why does this guy want to buy 10,000 shares here of this stock? So before you give him a price and sell him 10,000 here, probably shorting the stock and being or seeing some heavy short exposure here, you double check Bloomberg in this case, which is then bringing you hopefully some information on what's going on there. For such trading, well, probably Bloomberg is the right thing, but today I don't use this anymore, and it does not bring me any value in my trading. So that's the reason why I don't use this. There's also a question around Euro USD. I'm surprised that you're asking, because I'm not sure what do you think will be my answer on what's my take on Euro USD when looking at this picture here. So as you can see, from the end of January onwards, it's clear sideways action. So which means there's no real advantage to be found, not on the downside, not on the upside. It's just neutral. I have to say that I think that this is not intraday, but it's more like to be a view in the future here. I think it could be we could get to see a quite surprising move here, and it's not on the upside, but in fact on the downside in Euro USD. In this case, keep in mind that next week on Thursday we have the ECB meeting. But very interesting to note here in this context the following. It's not only the ECB and a potential down talking from Mario Draghi taking place here, but it's also that I somehow spotted a potential sentiment extreme in the US dollar index future. Therefore, just let me just see here on the other screen whether I find the chart here. On the commitment of traders report for US dollar. Yes, there we go. So 1 second. So this is a chart which is was prepared by John Kicklighter, and it's clearly showing here in deep gray, let's say, it's the US dollar index, and in light gray, this is the positioning in the commitment of traders report, net futures positioning. Which we can clearly spot is that the market is currently heavily net short US dollar. And it's in fact in the region around the most extreme positioning in the last 7 to 8 years. And when looking at this, it's not sad that the market will reverse sharply, but at least the market is probably a little too aggressively net short US dollar, which makes it likely that there will be rather sooner than later an unwind of this aggressive short position, meaning US dollar could see some significant pullback here. And on top of that, I'd like to add something which I already presented in the morning meeting before. It's around the LIBOR OIS. And here, let's have a look at zero hedge. Let's just hope that I get the chart quite fast. Why is that? Usually there is a strong positive correlation, at least back towards 2016 here. What you can see is, in this case in blue, it's the US dollar index future. And you can, that's something we mentioned several times, that's that the LIBOR OIS took off aggressively into the start of the new year. And it's a 3-month LIBOR OIS spread here. And what you can see is that the dollar index is usually following that, respectively, both of these markets are following each other. And it's probably not unlikely that rather soon or later US dollar index future will take off too here and follow the LIBOR OIS in this case. So in combination with this sentiment extreme, potential sentiment extreme, I think the US dollar has probably some potential to outperform and at least see a breakout of this downward channel here on a daily chart. So breakout here and a push towards and above 91 is probably about to see a breakout of this consolidation area in the Euro USD here on the downside too, which is surprising when looking here at this current picture. You can clearly spot a sequence of higher highs and higher lows, and you would clearly say this is a bullish consolidation. And from a technical perspective, there's no question about that. But this is the thing. These developments in the US dollar index future are, in my opinion, something to worry about, and probably we get to see a surprise on the downside with this sentiment extreme pushing Euro USD significantly lower, probably on top of that triggered by some dovish comments then from Mario Draghi made next week on Thursday. Yeah, I just hope that this answers your question. Okay. Yeah, and in fact, that's it from my end. So today we keep things a little shorter, as usual. So I have another appointment now in 50 minutes, and that's one of the reasons. No, I have no clue who this is. I have no idea. Did he make some same, or did he give some same thoughts on as I did on the LIBOR OIS or something? Or why do you ask? That would be definitely very interesting. However, yes, I wish you all the best. Happy trading. Watch your stops. Talk to you again probably tomorrow in the morning meeting, 10:30. No, it's 9:30 a.m. GMT in the YouTube channel from JFD Brokers. I definitely will look forward to it. I wish you all the best. Happy trading. Watch your stops. Take care. See you, and bye-bye.